Alright, here we go. Friday, September 27th, TGIF. I didn't have a chance to make a video yesterday. Sorry about that, guys. Doing it now. Let's talk. What are we going to talk about? Fed. The other day, actually, maybe it was Wednesday, they announced, again, another one of these surprise announcements without any kind of forewarning whatsoever. Said, hey, these repos we're doing, we're gonna up the amount. So the 75 billion overnight repos that they've been doing, that went up to 100 billion. And the 14-day term repos that were 30 billion, they doubled those to 60 billion. So we had more repo activity yesterday. We had the 14-day term repo. And today we had another 14-day term repo. Now, as I've been explaining to you people, these repo operations are disruptive to the market. It's like just, it's like shoving a whole bunch of food down your throat at one time. You gotta digest it. Now, these operations may have been necessary for reasons that I explained before, where the Fed actually took reserve balances down too far given the rate of loan growth, okay? And given the level of deposits. Remember, they need 10% reserves for the amount of deposits that they have. So deposits had been growing very quickly. And what's that? That's a function of income, right? And government spending. And loan growth was growing very quickly. And so they were guiding reserve balances down. That was their policy that had been in effect since December 2017. But additionally, and what I told you, the glitch, the kind of, the trigger, what made this so acute, the problem back in early September, was that once they lifted the debt ceiling at the end of July, what happened? The Treasury basically sat on its hands for the whole month of August with very little new issuance. And then all of a sudden, wham, in September, in the beginning of September, they start, ramping up bond issuance, and that hit at the same time when we had a big tax payment, corporate tax payments in September, and reserve balances went way, way down. It went right to the crucial threshold of 10% reserves. There were no excess reserves in the system. No excess. Like, what are these guys really don't know what they're doing. I mean, look, I've been talking about Powell for a long time. This guy, he has no clue. They got no clue. Now, all right, so they had to engage in these things to kind of resupply the system with reserves. That's good. I mean, they are rectifying the problem. But now, imagine this scenario. You're starving. You haven't eaten in days. All right? Then all of a sudden somebody comes along and shoves a big, huge meal down your throat. Thanksgiving dinner. Boom. Just in one shot. You didn't eat in a week. Nothing. Your stomach shrunk. Your whole intestinal system and digestive tract has nothing in it. And somebody comes along, boom, and shoves an entire Thanksgiving dinner down your throat. What do you think that's going to feel like? You're just going to, hey, no problem, let's have another one. Yeah, and dessert on top of that too. No, you're going to be like, oh, having the worst cramps. Your stomach is going to be so stretched out. You're going to be in pain, man. So that's what's happening right now. Eventually, the food gets digested. You got nutrition back in your body, right? So they're rectifying the situation. But these policies of like, they're just kind of like pulling them out of thin air. Now it's interesting because the one guy who I would never suspect understands these things, Neil Kashkari, who, remember this guy? I mean, he was on the Fed for a long time. He was the protege of Hank Paulson, who was the Treasury Secretary, that all during the crisis, this guy who was the master of the universe, CEO, chairman of Goldman Sachs, he went home. In his book, he said he kneeled down by his bed with his wife and he prayed to God, please help. But the master of the universe of Wall Street had no clue what to do when it came to the financial crash. Anyway, Neil Kashkari was his little protege. Then when Paulson left Treasury, Kashkari, he left, he was at the Fed for a while, then he left the Fed. He went to manage some money at PIMCO, and he was a disaster. He was a disaster at PIMCO. And then he quit PIMCO, and then he tried to run for governor of California, and that was a no-go right there. So, of course, what's he going to do, right? He went back to the Fed. These guys, they always go back to what's comfortable for them. So anyway, then he's been the rah-rah cheerleader all along of let's bring rates down to zero. Let's bring rates down. And I think it's because that's what Trump was saying. So he was like kind of shadow auditioning for the Fed job, for the chairmanship job. Because whenever Trump said, hey, rates ought to be at zero, like Kashkari would be right there 5 seconds later, hey, we got to cut rates to zero. So I laugh at this guy. But the thing is, he comes out today and he says something which hit me like, wow, man, the guy finally said something that shows he understands at least a little bit. He said, monetary policy should not be impacted or directed or focused on these issues of system stability. That has to be rectified with regulatory changes, and he's exactly right. It's very hard for the Fed to conduct monetary policy nowadays without impacting the banks. For example, all this stuff I've been talking to you about when the Fed adds reserves either through QE or whatever, and how, just that example I gave you about banks can't digest it right away, and it sends all risk assets down. That's a regulatory issue. For example, bank reserves are included in the consolidated assets part of the supplemental leverage ratio equation. What's that equation? I gave it to you last time. It is Tier 1 capital divided by consolidated assets. So when the denominator there, when the Fed rams all these billions and trillions into the banking system, the denominator gets very big and it brings that leverage ratio down below mandated levels, forcing the banks to either have to cut back on lending or actually sell some of their risk assets. And that's what causes the selling. Somebody asked me the other day, Mike, what causes a crash? Very easy. This kind of stuff. What causes a crash and what causes a recession? Both related to government. The crash is caused by this kind of stuff, monetary policy actions that trigger events in the banking system and then in the markets. Recessions are caused by government spending that drops to levels which is too low to support incomes and the credit structure, and then everything contracts. So there you have it, everybody. You learn all this stuff when you got my report, MMT Trader. Go to my website, sign up for a 30-day trial. Go to pitbulleconomics.com, sign up for a 30-day trial of MMT Trader. Now, I'll tell you, if you sign up, I'm going to give you the date when all this stuff goes away and we get the buying opportunity for the market. Because let me tell you something, the market is going way, way higher. But we have to get through this turbulence first. And the Fed is going to be engaging in these things, I think they said till October 10th. So, and then there's a period of time after that, and I'll tell you when that is. Just go to my website, pitbulleconomics.com, sign up for a 30-day free trial of MMT Trader. Bye, everybody. Have a great weekend. Bye-bye.